All right, so we're diving into Wharf Holdings' 2023 annual report today. You've given us a lot to unpack: financials, shareholder info, even stuff about their community work.
Definitely a lot to cover, but we'll break it down into manageable chunks, figure out how they're doing in this crazy global economy.
Sounds good. So first things first, what is it that Wharf Holdings actually does? I know they have those famous buildings all over Hong Kong, but it seems like a lot more than that.
You're right, it's more than just skyscrapers. They have five main business segments: investment properties, development properties, hotels, logistics, and then their investments. Let's start with investment properties, their core business. It's mostly about leasing out top-tier office and retail spaces, mainly in Hong Kong and mainland China.
Okay, so like those fancy malls and office towers that everyone pictures in Hong Kong, how did that segment do in 2023?
Not their best year, honestly.
Mm.
Even though it's their bread and butter, investment properties had some real challenges. Revenue dropped 1%, operating profit fell by 2%. Not great numbers for their core business.
Ouch. What caused that downturn?
It's a few things happening at once. Right now, there's too much property on the market, but not enough demand, so that pushes rental prices down. And then, the Chinese yuan weakening against the Hong Kong dollar didn't help either. The report even said things would have looked worse without the yuan's translation impact.
So even their core business is feeling the global slowdown. What about their development properties segment? That's where they actually build and sell places, right?
Exactly. They develop residential, office, and retail properties mostly in Hong Kong and mainland China. This segment took a hit too, with a big drop in what they call recognized gross floor area. Basically, it means the real estate market is slowing down.
Makes sense with everything going on. Did this translate into bad numbers for development properties?
It hurt profits, but not as badly as you might think. They actually had lower impairment charges this year compared to 2022. Looks like they took a big hit last year with write-downs, so this year's results are better because of that comparison.
Interesting. So two segments down, kind of a mixed bag. What about hotels? Are people traveling again post-COVID?
Now, this is where things get interesting. Hotels were the star performer for Wharf Holdings in 2023, which is pretty surprising because the overall market was generally quieter, according to the report. They must be doing something right to go against that trend.
That's a good sign. Do we know what they're doing that's working so well?
They don't get too specific in the report, but it probably has to do with their focus on luxury hotels and strategic spots. They operate brands like Marco Polo and Niccolo Hotels. Those have good reputations and loyal customers. It seems like their post-COVID comeback strategy is paying off.
Makes sense. Let's move on to their logistics segment. I'm curious how global trade is impacting them.
This is all about their container terminal operations, mostly through modern terminals in Hong Kong and Shenzhen. So yeah, global trade is huge for them. And unfortunately, there was a severe downturn in global trade, which hit container traffic hard and hurt their revenue.
Another segment with challenges.
Mhm.
Then there's the investment segment.
Right.
What's their approach there?
Wharf Holdings takes a long-term view with investments. They mostly own shares in publicly listed companies, especially blue-chip companies. They're aiming for long-term capital growth and stable dividend income. But all the market ups and downs lately would have definitely impacted their investment portfolio.
Okay, so we've gotten a quick look at all five segments and the challenges they faced in 2023. Now, let's look at their overall financial performance. Their revenue went up 5% to HK $18.95 billion. That sounds good, right? But how does that fit with all the struggles we just talked about?
That's a great point. It shows why you got to look deeper than just the top-line revenue number. The total might look positive, but remember, that hides the problems in segments like investment properties and logistics. Their growth was mainly thanks to the hotel segment doing so well, which balanced out the declines elsewhere.
So the revenue increase is a bit misleading. What about profitability? Did they manage to turn that revenue into bigger profits?
This is where things get really interesting. Their underlying net profit jumped a massive 1,077%, hitting HK $3.566 billion.
Whoa, that's huge. Did they
Yeah.
strike gold or something?
Haha, not quite. It's mainly because of a much lower impairment charge this year compared to last year. Remember, 2022 was rough, especially for development properties. So this year's profit looks great, mostly because of that comparison, not just explosive growth.
Right, a rebound from a tough year.
Yeah.
Okay, what about dividends? Did shareholders get a piece of that profit pie?
This is curious. Dividends stayed flat at HKZ$40 per share. You'd think a company with such a big profit jump would reward their shareholders, right? It makes you wonder about how committed they are to shareholder value.
Investors will definitely be thinking about that. Could their flat dividends have to do with other financial stuff, like their debt?
It's possible. And speaking of debt, their net debt actually went up a big 47% in 2023, reaching HK $7.8 billion.
Wow, that's a big jump. Why did that happen?
The report says it's mostly from buying long-term investments. Remember, their strategy is to hold stakes in those blue-chip companies. So this debt increase could be them putting their money where their mouth is when it comes to that long-term plan.
So more debt to fund those investments. But more debt always means more risk.
Right.
For sure.
Higher debt makes things riskier, especially if interest rates go up or those investments don't perform as expected. It's a balancing act between going for growth and managing risk.
Talking about balancing acts, you mentioned dividends earlier. Do they do anything else to boost shareholder value, like buy back shares?
That's another interesting point. The report doesn't say anything about share buybacks, which is strange because buybacks can be a good way to give value back to shareholders, especially if they think their shares are underpriced.
So no buybacks, even with a profit jump and their talk about shareholder value, that raises some questions. Do you think they don't have confidence in their stock's price? Or is that a strategic move to focus on other things?
Good question. We'll have to look closer. Let's see what they're doing with their building for tomorrow approach and how that fits into all of this.
Building for tomorrow. What's that all about?
It's their idea of long-term sustainable growth. It goes beyond just focusing on the financial returns. They're also emphasizing responsible practices, working with the community, and investing in new opportunities.
So it's not all about profits, but also about building a business that can last, even when things are unpredictable. This building for tomorrow approach, could it affect their financial decisions? We already talked about the conservative dividends and no buybacks. Are there other places we see this philosophy playing out?
Definitely. Look at their debt management strategy, for example. Remember, their net debt increased a lot, mainly because they bought those long-term investments. This could be a calculated risk to set themselves up for future growth.
That makes sense. They're using debt to get assets they think will make good money in the long run, even if it means taking on more risk now. But it's still a gamble, right? What if those investments don't work out or the economy gets worse?
There are definitely risks, just like with any investment. But they're focusing on high-quality, blue-chip companies with a good track record. And they're not putting all their eggs in one basket. Their different business segments help spread the risk.
Right. The different segments protect them if one market or industry struggles, like how their hotels did so well, making up for problems elsewhere. It's like they've got a diverse investment portfolio, but instead of stocks, it's hotels and malls and terminals.
Exactly. And their building for tomorrow idea applies to each of these segments. They're always trying to innovate, be more efficient, and adapt to the changing market. For example, in their investment properties, they're testing new retail ideas and using technology to make the customer experience better.
So they're not just sitting back and collecting rent. They're actively trying to stay ahead of the game. That's encouraging. But what about their development properties? That sector's facing some tough times. How are they planning to deal with those challenges?
They're being cautious, focusing on specific development projects and choosing ones with strong fundamentals. They're also looking at new markets and opportunities, like expanding into mainland China more.
So they're not giving up on development properties, just being more strategic and picky. It seems like this building for tomorrow philosophy is behind all their decisions. But at the end of the day, investors want returns. How does this long-term focus actually create value for shareholders?
That's the big question, right? The point of building for tomorrow isn't to throw away short-term profits for some vague future goal. It's about creating lasting value for everyone involved, including shareholders.
So it's not a choice between one or the other. They believe that by focusing on long-term value, they can get stronger returns for shareholders down the road. But how can investors be sure this will actually work?
You have to look beyond just the current numbers and consider their track record, their management team, and their ability to make their strategy happen. Wharf Holdings has a long history of adapting and delivering value to shareholders.
They've been through a lot: economic crises, political changes. So their track record shows they can handle the current challenges. What about their management team? Are they the right people to lead the company forward?
Their management team knows these markets really well and has a good track record. They're also fully on board with the building for tomorrow idea, which gives the company a clear direction.
So they have the experience, the skills, and the vision. But execution is what matters. How can investors be confident they can actually pull off these ambitious plans?
That's where it gets interesting. We need to look at their past performance, what they're doing now, and their plans for the future to see if they can actually execute their strategy.
Okay, let's do that. Let's dig into their recent performance and see if this building for tomorrow approach is really working. What should we be looking at?
We can start with return on equity, ROE. It's a big profitability measure that shows how well a company uses its shareholders' investments to make money.
So ROE tells us how well they're using shareholders' money to make more money. What does their ROE say about how they're doing?
Their ROE has been going up steadily, which means they're getting better at making profits. This is good. It suggests their investments and improvements are working.
Their ROE shows that building for tomorrow is actually bringing in financial benefits. What other numbers can we look at to judge their performance?
Operating margin is another important one. It measures how profitable their main operations are.
Okay, so operating margin tells us the profit from their core businesses, before things like interest and taxes.
Yeah.
What does their operating margin tell us?
Theirs has been improving too, meaning they're controlling costs and working more efficiently, which is impressive considering all the challenges they've had.
So they're getting more profit out of their core businesses despite the tough times. Shows how good they are at operating and adapting. What other financial metrics can help us understand their performance?
We can also look at cash flow generation. That's a crucial sign of how healthy a company is financially.
Right, cash flow is king. What does their cash flow tell us?
Their cash flow from operations has been strong, meaning their main businesses are bringing in good cash flow. This is important because it lets them invest in growth, pay dividends, and lower debt.
So they're not just profitable on paper, they're actually generating real cash. That gives them the power to do what they need to strategically. This is all very encouraging. But what about the future? Can investors be sure Wharf Holdings can keep this up and keep delivering value in the years to come?
That's the key question. And to answer it, we need to look beyond the numbers and think about their future prospects. Let's dive into their strategic plans and see what they have in store.
I'm ready. Let's see their project pipeline, expansion plans, and overall vision for the future. What are some of the big things they're working on?
One big focus is expanding more in mainland China. They're buying and developing properties in major cities, trying to take advantage of the country's economic growth and people moving to cities.
So they're betting on China's future, which is risky with all the economic and political uncertainty. But if it works out, it could be a huge win for them. What other strategies are they pursuing?
They're also investing a lot in innovation and technology, especially in their retail and hospitality businesses, using new tech to improve the customer experience, work more efficiently, and grow.
So they're not just beating buildings, they're also investing in digital stuff to create a better customer experience. That's essential these days. What else do they have planned for the future?
They're looking at new business opportunities too, like expanding their logistics operations and trying out new sectors like healthcare and education.
So they're not afraid to try new things and expand into areas with potential for growth. They're not just sticking with what they know, they're actively looking for new ways to create value. This is exciting. But with these big plans, what are some of the biggest risks and challenges they're up against?
One big risk is the global economy being so uncertain. A long slowdown could hurt demand for their properties, services, and investments.
That's a valid concern. They operate globally, so there are things outside their control that could affect them. What other challenges are they facing?
The competition is getting tougher in their main markets. They have to compete with local and international companies, which puts pressure on their profits and forces them to keep innovating and standing out.
So they can't just relax. They need to be quick, adaptable, and always looking for ways to stay ahead of the game. What other risks should investors be aware of?
The regulatory environment, especially in mainland China, is a risk too. Changes in government policies could affect how they operate and how much money they make.
So political and regulatory risks are always there, especially in a place like China, which is complex and changing. It seems like Wharf Holdings has lots of challenges, but also exciting growth opportunities.
How do you weigh those when thinking about their future?
It's complicated, no easy answers, but by looking closely at their past, their management, their strategies, and the risks they face, investors can get a better idea of their long-term potential.
All right, we've covered a lot in this deep dive. Their financials, their building for tomorrow approach, and what the future might hold. What are some key takeaways you want to leave our listener with? One big takeaway is that Wharf Holdings is a tough and adaptable company with a history of success. They're dealing with the current challenges by focusing on long-term value and sustainable growth.
They're not just chasing quick profits. They're building a business for the long run. What other insights do you have for our listener?
Another key takeaway is that they're taking risks to set themselves up for future growth, but they're doing it carefully. Their strong finances, diverse businesses, and experienced leaders give them a good foundation for future success.
They're not afraid to take risks, but they're doing it strategically. What else should we highlight?
Their building for tomorrow approach is more than just words. It affects everything they do, from investments to community work. This long-term focus and commitment to sustainability make them stand out and could give them an advantage in the long run.
So they're not just building a business, they're building a legacy. They're investing in the future, not just for themselves, but for everyone involved. That's inspiring and something investors should definitely consider when thinking about their prospects. What final thoughts do you have for our listener as they start their own deep dive into Wharf Holdings?
Remember, this deep dive is just a starting point. Don't just rely on this information. Do your own research, look at different viewpoints, and explore the things that matter most to your investment goals.
Excellent advice. Don't just take our word for it. Do your own homework, analyze the info, and come to your own conclusions. Investing is all about making smart decisions based on your own situation and how much risk you're comfortable with. We've given you the tools. Now it's up to you to use them well. And as always, the best investment you can make is in your own knowledge. Keep learning, keep exploring, and keep diving deep.